Hello, everybody. My name is Wes. I'm your financial advisor coming to you from the Florida Keys. Capital gains tax is one of those topics people hear about all the time, especially in the world of finance and the stock market, but very few actually understand how it works. Today, I'm going to break down what capital gains tax is, when it applies, how short-term and long-term gains differ, and why where you invest matters. Once you understand this, you'll be able to make more informed investment decisions without overthinking it. So, what actually is capital gains tax? Well, capital gains tax is the tax you pay on the profit from selling an asset. If you buy something for one price and sell it later for more, that profit is called a capital gain, and that's what might be taxed. Now, if you don't sell the asset, there is no capital gains tax owed. Those are called unrealized gains, but we'll get into that later. However, what counts as a capital gain? Well, capital gains can come from things like stocks, ETFs, bonds, mutual funds, and even real estate. The key idea is simple though. Buy, sell, and if you make a profit, there's a potential tax. Losses, on the other hand, are called capital losses, and those can sometimes be used to offset gains. Moving on, how long you hold an investment before selling it actually matters, especially when discussing capital gains tax. Now, there are two categories you have to be concerned with. You have short-term capital gains and long-term capital gains. Short-term capital gains apply when you sell an investment you've held for 1 year or less, and these gains are taxed at your ordinary income. On the other hand, long-term capital gains apply when you hold an investment for more than 1 year. And these gains are taxed at a lower preferential tax rate, which is one of the biggest benefits of long-term investing. And I'll go into more detail on that on the next slide. So here's a general breakdown of long-term capital gains tax rates at the federal level. Now, these are generally taxed at 0%, 15%, or 20%, depending on your income. And this is significantly lower than most ordinary income tax rates, which the short-term capital gains deals with. That difference alone is one reason long-term investing is often more tax efficient. However, one thing to note, gains are stacked on top of ordinary income and not taxed in isolation. So I want to make a clear point, especially in this video. Capital gains tax are triggered only when you sell an asset. You can see gains on paper for years, but until you sell, those gains are considered unrealized. Once you sell and lock in that profit, the gain is what we call realized. And that's when the taxes come into play. Where you invest also matters. In taxable brokerage accounts, capital gains tax may be owed when you sell investments. On the other hand, tax-advantaged accounts like IRAs, Roth IRAs, or 401ks, their capital gains typically aren't taxed when trades occur inside the account. That tax deferral or tax-free growth in the case of a Roth account can make a big difference over time. So what actually are capital losses? Well, capital losses occur when you sell an investment for less than what you paid. These losses can sometimes be used to offset capital gains, which may reduce your overall tax liability. This is part of why tax planning and investment strategy go hand in hand and are quite important. To wrap all this up, capital gains tax isn't something to fear, it's something to understand. How long you hold investments, when you sell, and where you invest all play a role in how much tax you may owe. The goal isn't to avoid taxes entirely, though. It's to make informed, intentional decisions. I thank you all so much for watching. I'm always looking to improve my craft, so if you believe I could improve on anything, or please let me know in the comments below. Have a wonderful day.